SoFi Technologies is trading right now at an intraday price of $17.18 per share, representing a sharp move upward of 3.62% during today's trading session. While the retail trading boards are celebrating this bounce as a clear sign that the recent multi-month slide has finally found a structural bottom, the reality unfolding behind the scenes is far more complex than a simple relief rally. The immediate temptation for anyone watching this asset is to assume that a fintech company showing massive user growth must be an automatic buy when the price drops. But looking closely at the massive institutional volume blocks tells a completely different story. A massive divergence has opened up between the aggressive retail narrative and the cold math governing institutional order flow, which is where the real value is either being created or destroyed. The common expectation among most retail participants is that because this company recently posted a blockbuster first quarter with net revenue hitting a record $1.1 billion, the equity should naturally gravity feed back towards its old highs. People look at the surface numbers and see member growth jumping 35% to nearly 15 million users and assumed the business is an unstoppable juggernaut that traditional banks simply cannot compete with. It is an appealing narrative, especially for those looking to self-investing paths through modern platforms. But the underlying reality is that institutional desks are not trading the historical numbers anymore. They are pricing the structural cost of capital in a macroeconomic landscape where interest rates are stuck at elevated levels. This structural reality has completely rewritten the playbook for online investing, forcing a massive re-rating across all fintech equities. To truly understand what is driving the daily swings and the massive trading volumes we are witnessing right now, you have to look at the massive tug-of-war happening between short sellers and institutional accumulators. Heading into June, the short interest on this asset had reached absolute boiling point levels, driven heavily by high-profile short seller reports alleging accounting complexities and an ongoing class action probe. When a stock is compressed that heavily by short positions, any positive operational development does not just bring in standard long buyers, it triggers a violent cascade of short covering. That is exactly why we saw that massive 17% surge over a 5-day window, where trading volume crossed over 150 million shares in a single session. It was a classic liquidity squeeze, not necessarily a fundamental re-rating, and that distinction is exactly what separates long-term winners from temporary momentum traps on modern investing sites. While this intraday move to $17.18 feels incredibly strong, we cannot ignore that the stock has shed a massive percentage of its value over the past 6 months, drastically underperforming the broader financial sector. This massive drop occurred despite the company delivering a staggering 134% increase in net income, which climbed to $167 million in the first quarter of 2026. This brings us back to the classic gap between expectation and reality. The market aggressively punished the equity after that record earnings report because management chose to keep its full year 2026 revenue guidance flat. To the algorithmic trading desks and institutional wealth managers, flat guidance after a massive quarterly beat signals that the back half of the year faces severe hidden headwinds that might not be visible in the current consumer metrics. The institutional activity over the last few weeks shows that big funds are starting to treat this price level as a highly strategic battleground. Major disclosures showed massive asset managers accumulating shares at these depressed levels, providing a structural floor to the price action. At the exact same time, the options chain is showing massive open interest in out-of-the-money calls expiring later this month, indicating that derivative traders are positioning for a massive breakout or a violent breakdown as we get closer to the next quarterly report in July. If you look at how major investment setups handle these types of high-beta financial tech assets, the allocation strategy is completely different from how they approach stable tech giants or standard consumer banks. Let's look at the competitive reality through the lens of individual brokerage options and online investment trends. When a retail user looks for investment help or decides to invest online, they are faced with an absolute ocean of choices. They can look at massive legacy giants like Fidelity Investments, which attract trillions in capital through traditional Fidelity ETFs, Fidelity mutual funds, and their massive Fidelity wealth management divisions. These legacy users enjoy the security of a massive institution, using the Fidelity mobile app or the main Fidelity trading platform to manage long-term wealth, often utilizing Fidelity IRAs for tax-advantaged growth. Alternatively, a younger demographic might lean heavily into a platform like Robinhood, where Robinhood stock trading, the incredibly slick Robinhood app, and speculative features like Robinhood Crypto drive intense engagement. Robinhood has aggressively expanded its ecosystem with Robinhood Cash Management, Robinhood Fractional Shares, and high-yield cash features to lock users into their platform. Then you have the absolute professional heavyweights using Interactive Brokers, where Interactive Brokers Trading and the highly advanced Interactive Brokers platform attract high-net-worth individuals and active day traders due to ultra-low Interactive Brokers fees and advanced institutional routing across every imaginable Interactive Brokers account. In this hyper-competitive landscape, Sofi Invest has had to spend absolute fortunes on user acquisition to carve out its market share. This is where the operational tension lies. To compete with the massive balance sheets of legacy platforms and the zero-fee allure of modern trading apps, the company must constantly innovate its ecosystem, launching active digital features like its automated intelligent portfolio systems to match services like Schwab Intelligent Portfolios. While these moves successfully drive user metrics higher, the customer acquisition costs and heavy technology investments act as a massive drag on near-term operating leverage. Traditional investors look at the valuation multiples and get incredibly nervous because the stock trades at roughly 24 times forward earnings, which is vastly higher than the traditional banking industry average. Comment below how many shares of Sofi stock you currently hold in your portfolio and whether you are buying this dip or waiting for the July earnings call. When you strip away the modern marketing and look directly at the underlying core business model, this company operates as a unique hybrid between a high-growth technology platform and a traditional federally chartered bank. The crown jewel of their entire structural setup is their Office of the Comptroller of the Currency National Bank Charter. This charter acts as a massive competitive moat because it allows them to gather billions of dollars in low-cost consumer deposits from their millions of members. Instead of relying on expensive warehouse credit lines or external institutional funding to back their loans, they can use their own member deposits, significantly lowering their funding costs. This banking charter is exactly what makes them structurally more resilient than pure-play fintech lenders who are completely exposed to the whims of the capital markets. The company's revenue engine is split into three distinct segments: lending, financial services, and their technology platform. Historically, student loan refinancing and high-end personal lending were the primary drivers of growth. However, when interest rates spiked and remained elevated, consumer behavior shifted dramatically. The incentive for a consumer to refinance a student loan or take out a massive personal loan drops off a cliff when borrowing costs are at multi-year highs. This has forced the business to aggressively pivot towards its financial services segment, driving massive adoption of its checking, savings, and investment accounts. The recent launch of their national bank-issued stablecoin, designed to allow members to interact directly with on-chain payment rails inside a banking app, represents an aggressive attempt to capture high-margin transactional fees that are completely unlinked to interest rate fluctuations. Despite these technological advancements, credit quality remains the absolute most critical risk factor that every investor must monitor with absolute discipline. In an environment where personal loan originations have reached record levels, any meaningful tick upward in consumer delinquency rates will force the company to aggressively increase its loan loss provisions. If they are forced to set aside massive amounts of capital to cover potential bad debt, those reserves will immediately eat into their reported net income, completely destroying the profitability narrative that the bulls are currently relying on. This credit risk is precisely why the broader market refuses to afford the stock the same premium valuation multiples seen in mega-cap technology or high-margin software ecosystems. Looking ahead at the future outlook, the stock is trapped in a defining expectation versus reality framework that will likely resolve over the next 2 quarters. The market expectation is highly cautious, projecting that persistent macroeconomic pressures and intense deposit competition will continue to compress net interest margins and limit bottom-line expansion. The reality, however, could surprise to the upside if the company can demonstrate significant operating leverage during the upcoming July earnings release. If management can maintain its explosive user growth while simultaneously raising its full-year guidance, the narrative will instantly shift from a struggling rate-sensitive lender to a highly efficient digital banking powerhouse. Conversely, if credit metrics deteriorate even slightly or if funding costs rise faster than asset yields, the equity will likely retest its absolute 52-week lows. To summarize the central insights of this analysis, the current intraday upward move to $17.18 is a highly visual representation of the intense technical and fundamental friction anchoring the stock. The expectation built around record revenue and massive user acquisition is constantly bumping up against the reality of a restrictive macroeconomic environment, heavy customer acquisition costs, and short seller pressures. While the national bank charter and innovative product rollouts provide a sophisticated structural foundation that legacy competitors struggle to replicate, the valuation still demands an aggressive level of execution that leaves absolutely no room for operational errors. Navigating this asset requires looking past the daily momentum swings and maintaining an absolute focus on credit quality, funding costs, and guidance adjustments, as these structural realities will ultimately dictate whether the equity achieves a permanent re-rating or remains a volatile battlefield for short-term traders.